Hey there, it's Jared Hamilton with the Hamilton Group at Cherry Creek Mortgage. Welcome to another edition of Java with Jared. Once again, happy Friday, everybody. Hope you guys are doing great and staying cool in this hot weather. Well, rates finished the week worse than where they ended last week, and that was primarily due to some of the Brexit concerns easing slightly. Also, the stock market has just been on a tear, and we are seeing some signs of inflation concerns. And so all that has added to some pressure for interest rates. Now, we've seen interest rates actually deteriorate, and the other thing is, too, it's also on the heels of last Friday's really strong surprise job numbers. Now, we have seen rates pull back fairly considerably here over the last week and a half, and that's primarily due to, all those things that I talked about. But rates are still better, remember, than where they were just before the Brexit. So we're still about the levels as we were around June 25th. So rates are still phenomenal, but we're off just maybe the record lows that we've seen, not only in interest rates, but 10-year Treasury. So things are still great, but they're just pulling back a little bit. And we had a lot of economic data that was released into the market. And here's what's kind of going on. First of all, we saw the producer price index, and that showed a bigger increase than what was expected. PPI was up 0.5%, and the year-over-year number was actually posted the first increase at 0.3% since 2014. Also, the CPI number came in up 0.4%. The year-over-year number was up 2.3% from 2.2%. And that is the highest reading that we've seen since 2008. So there are some inflation concerns here that are potentially spooking the market a little bit. And remember, inflation is interest rates' biggest arch enemy. Stocks also have been on a tear, as I had mentioned, and we've seen 5 consecutive new record highs set. So when money is flowing into stocks, usually bonds suffer a little bit, bonds and mortgage-backed security, because some of the money is going there as opposed to mortgage-backed securities. Now, rates are going to remain low, though, for at least the end of the year, because we still do have the concerns over the Brexit and what that means to the overall EU. We also are seeing, very, very low yields from a global perspective. Germany, Japan, Sweden, Denmark, all of those are showing negative yields. So just to park your money there, you're actually going to lose money every single month. And so that still makes things pretty attractive in the United States, where yields aren't fantastic, but at least you're not losing money. And also our currency is increasing. So foreign investors make money both those ways, just by higher yields here than there, and also because the dollar is continuing to gain some ground there. But there still are some of these inflation concerns. So what we need to do is just be telling our clients, just like in real estate, if you see a good deal, take it. We're going to see rates really, really low here for the remainder of the year. We're going to see opportunities. But when those opportunities arise, they may not last very long, just because we're going to see a lot of the volatility. And there are potentially some inflation concerns right now, and that is going to put a little bit of pressure on the market. We're still seeing rates phenomenally low, just off the records lows that we saw last week. But things are still going to be great, and they're still going to be good for quite some time. So get your clients out there, get them looking for a house, because it's a great time to either buy or refinance. But when you see those opportunities, take them. Thanks for joining me with Java with Jared. If you're working this weekend, so are we. So just give us a call. We're happy to help clients. And if you have any questions, always just give us a call. Thanks a lot, and we'll talk to you soon. Bye-bye.